Welcome to the Dental Money Lounge, the place where dentists can tune in to grow their money, wealth, and financial knowledge. Here are your hosts, Hassan Moushaid and Max Bazzucchini.
Hello, everybody, and thank you for joining us on another episode of the Dental Money Lounge. I am on Pluto Planet today. I'm in our offices in Kent, Pluto Partners. And I am delighted to say that I'm joined today by our regular co-host, Hassan Moushaid, everybody. Hassan, how are you?
I'm not too bad, Max. How are you?
I'm very good, thank you. Very good in my new office in Kent. So today we are joined, I'm delighted to say, by our close friend and specialist dental accountant, David Hossein from Brook. Hi, David. How are you?
Hi, Max. Hi, Hassan. I'm very well. Hope you guys are too.
Yeah, really well.
Yes, absolutely. So today, again, we over the last few weeks, we had some amazing speakers coming to our show. We had the likes of, just to name a few, Tif Qureshi, Shiraz Khan, Barry Orton, Hossein. And today, I'm delighted to have a conversation with David Hossein. Over the years, we worked together on a number of deals with some of my clients, and David was advising on either buying or selling practices. And today we're going to talk about, as a dentist, the level of conversations that you should have with your accountant when you're either buying or selling practices. So David, over to you.
Thank you, Max. So thanks for the short introduction there. And I think that in a nutshell, I would say that engage with your accountant both positively and proactively. You're quite right, Max, that we've worked on a number of deals, and if to focus on that in this specific situation and talk today, I think that I would split my support into two areas of buying support for associates. So when an associate client of mine is buying a practice, I will look at the valuation for them, and you have to look at that very closely, and you also have to understand the difference between profit and cash, which isn't something that is immediately obvious to an associate who might not have run a business before. And I have seen it far too many times where an associate buys a practice and is actually worse off having done so. But there are simple things you can do before to make sure you don't fall into that category. Looking at your return on your investment is certainly the first thing to consider. After that, how does your cash position look once you've had to do things like pay the bank back, once you've had to consider paying the principal as an associate if they are staying on for any private work that you might be purchasing, and looking at those two things together and saying, well, what is the cash position that's left? Because when the practice is marketed to you, it's marketed based on profits. Now, those should really be historical profits and not forecast profits. There's obviously one is a figure that has been achieved in the past, and the other is a figure that could be achieved. So that's really important to get right. Worth mentioning that over the last, I'd say 10 years, we have seen a bigger gap growing between the completion prices and the asking prices. That's well published amongst the NASDAQ reports of the Goodwill quarterly reports that come out. So valuations are increasing, but that doesn't necessarily mean that those are the prices that you should be buying at. The last thing I want to see any of my clients do is stretch themselves too thin, buy something they can't afford, and suffer with that for 10, 15 years. And it is something I have seen too many times, so I wouldn't want to see it for any of my clients.
Well, I couldn't agree more with you, David. We always talk about this, and as you know, and some of our listeners might know, I used to be a buyer myself. So I've been in the industry now for just over 10 years, and I've been in the selling side, on the broker side now for 4 years. And I can see that there is a high level of competitiveness between different brokers, and this can very often cause some of the brokers to overvalue a practice, and it's very easy for a dentist, let's say because of naivety or human nature perhaps, to try and go with and choose and work with the broker that comes with the highest valuation. But highest valuation is not always the best option, as you know, and I see more frequently than ever now with some of the brokers, practices coming to market and staying on the market for a long time and not getting any offers or not getting the interest that they would generate if they were priced at the right level. And then they come back to market after a few months with a reduced price to sale price tag. And this, of course, is going to have a very, very negative impact on the practice owner and on the market indeed. So I agree 100% with you, what you're saying.
Yes, absolutely. And that's what I would put in the pre-completion planning section. Then you move on to the completion process itself. For that, you will need a lawyer and an accountant to look at it. And I think that the other common thing that I see is involving the accountant far too late in that process. It's often the case, especially when you're buying shares, that you need to look closely at how the completion accounts will work. A review of the balance sheet needs to happen, and you need to see and flag any potential problems early on. Typically, dental practices will either be a sole trader partnership or a limited company, and the difference between the two is that when you buy a practice that is a sole trader, you are buying the goodwill and the assets, and you start with a clean slate as a new business. So those are transferred to you, who you then become the business. With a limited company, you purchase the shares of that business, and the business is transferred. So the business stays within the limited company, and you inherit all of the historical tax-related issues there, but also the balance sheet in its entirety as it is. And if you think about that from your point of view, if you are buying shares mid-year, that company will have all sorts of liabilities to account for, the main one being corporation tax, but others as well. And to reflect the liabilities that you could inherit, there's often a clause for a net asset adjustment. So that will be either money that is paid back to you, or depending if it's the other way around, money that you would have to pay over to the shareholder after completion to account for timing differences. So when you buy mid-year, which is often the case, you rarely complete a deal on the 31st of March.
Yeah. Okay. Well, I have to say to you, Hossein, obviously I know David well from working with him, and I also work with many other accountants. But what is actually positive and good about David is that he's got a real mentality of wishing to help others, wishing them, helping them to succeed. And I can see the level of advice given can really save thousands of pounds. Are you happy to or able to give us an example on a real case when something went very well and something was going perhaps on the edge of not going that well, and you might have to step in and maybe even giving advice to lawyers that didn't spot some of the potential issues that could have been arising, David?
Yes, I mean, happy to provide, obviously, without mentioning any names.
Yes, of course.
An example would be to make people aware of what could potentially go wrong and why it's important to engage with your accountant. So a recent deal that I worked on was a share sale. I spoke with the associate 6 months ago, and he advised me he was considering buying. So we agreed that he would get in touch once his offer had been accepted, and I could engage at that point. A couple of months passed after that, and the lawyers had been instructed and conversations had progressed, and they were ready to complete the week after, at which point the associate contacted me to say, well, just to let you know, we're completing next week. So I said, okay, please can you let me have a look at the share purchase agreement so I can take a quick look along with a copy of the accounts. And when we looked at the accounts, there was a large director's loan account of £300,000 in debit. And the seller's accountant and solicitor were asking for that to be left on completion, but cleared post-completion via the previous owner. So injecting £300,000 into the business. Okay, so sounds okay. But then the problem with that is now the balance sheet is very heavy in terms of assets. So the buyer has to purchase that cash from the seller. So he has to come up with £300,000 to buy the cash off the seller.
Yeah.
And he's obviously not got that money in the bank, so he would have to take it out of the company to repay the net asset adjustment. And obviously that's wrought with the difficulty. There's dividend taxes that he would suffer in that situation, and it could have been easily 150 grand worth of taxes that were passed over to my client. Obviously, I raised to all parties and said we have to put this on hold. I'm not happy for my client to proceed on that basis, and we restructured it so correctly the director's loan would be cleared by a dividend on completion, not by a repayment of the cash. And that's often the case, that when completing on a deal, there are certain decisions that can be made for the buyer or for the seller that give either of them a competitive tax position. And I think the key for me is being fair. So things that are normally the case, I would expect to continue to normally be the case. But things like this, I think this is an anomaly. It wasn't spotted until I got involved, and that's just asking your accountant to look at the deal structure. So very important to do that. An example of one going very well. So say 6 months ago, we helped a client who bought the practice, and it was a share sale again. There wasn't any issue like that. It went through. There was a corporation tax liability and associate fees that the seller had to pay for, and those were recovered within 30 days of completion. And that's really what you want. You want to complete the deal, finalize any loose matters, and get on with the business of running your business.
So when you get approached by a first-time buyer, and I know this, I've seen this happening, and also working with you, which I will give some examples later. But when you get approached by a first-time buyer and a client of yours, they have a sales brochure from a selling agent. What is the first step, and what do you advise the buyer to do?
Well, I would certainly say to give it to your accountant to look at. And the key with buying the practice is to be better off after you've done that. And that requires assessing where you are now in terms of what you are able to earn, and as well as lifestyle, what kind of work-life balance you have. And then analysing what life would look like on the other side. So you buy the practice, you've got all these new responsibilities, you've got all these new possibilities as well. If you're buying a practice that you can grow, possibly put a third or fourth surgery in, those are opportunities to explore. But there is a difference between the profits and the cash, and sometimes also the methodology for valuing. So I think that you need to look at the valuation method very carefully. You need to make sure at that point, a simple 10-15 minute conversation, say, well, what's your bottom line after you've bought this business? And if that's a positive, then I think the advice would be to explore the opportunity further, to make sure that you are buying something that is right for you in terms of not being worse off, but also, I'm actually, you're better aware than I am that goodwill valuations are very high right now. So
yes,
you're buying when prices are high. You want to sell with a return on your money. So can you increase that goodwill valuation? Can you increase the private side? Can you add extra treatments in to grow your revenue and your exit price? If those are yes, then yeah, by all means, this is something to consider. But you have to ask those questions and not be blinded by the headline figures. I think the headline figures don't give you the true story, and it's only when you get through the nitty-gritty that you see. I mean, as I say, the devil is in the detail.
Yeah, no, you're right. And for your benefit, Hassan, and anyone listening, David mentioned just now about there are different valuations methodologies when valuing a dental practice. So from what we use, the most common valuation methods are an income-based valuation method, where income is considered the pre-tax cash flow of the practice or the business. And also there is a market-based valuation methods and net-based valuation method, but the income-based is the most commonly used.
So David, you mentioned that obviously there's a few people that you've helped closer to the stage of actually completion, and if they had sought your help earlier and communicated with you properly, they may have been in a better position. Now, with the listeners who are existing practice owners, there must be benefits for them to communicate with their accountants on a regular basis. What type of benefits can they reap the rewards really from regularly communicating with their accountant?
Yeah, I think it is important to talk with your accountant regularly, and I think the key is proactively. The reality is that dentists work very long hours, and that's often because they're bringing in a lot of the fee income. So I understand time isn't always available for that, but as practice owners, there are a number of challenges that you will face. One of the often not talked about areas is just cash flow management. And the last thing I want to see for any of my clients is that we get to the end of the year, we have a conversation, and all I'm giving them is bad news. So this is your tax bill, this is when you need to pay it, and here's my fee for telling you. That doesn't really allow me to provide any value to the client. And if they've not budgeted for what that liability is going to be, it can put both them personally and the business under strain. Now, that's not good for the dentist personally, it's not good for the practice as well. A healthy practice is a practice that performs financially well, and that is the center, in my opinion, of the patient care. So I think having a formal budget, a formal cash flow model where they way they work towards targets. So every year it sat down and said, look, this is what we expect the business to perform. This is how we're going to monitor that. And if there are any changes, we can react to that proactively. That's certainly one area to help on. As I say, it's the difference between getting the historical data from your accountant where there's little you can do with it. This has been proactive. And I think that comes through in communication. A question that I'm asked quite often is, well, should I have annual accounts or monthly accounts? And it's not always the case that monthly is better for you. I think that for smaller practices, annual is fine. I think in a small practice, you know your level of fee income, your fixed costs are quite similar, and your variable costs are what they are. So you'll know how you're performing. However, in a bigger practice where you've got multiple fee earners, you need to be up to date with how everybody's performing, and you need to be seeing how that is contributing to your overall goal for the practice. And it might be that you need to sometimes speed things up, focus on certain treatments that you aren't delivering and that you thought you would deliver. And if you're not getting that information in a timely manner, well, there's little you can do about it. So I think the answer to that is it depends for the client. It depends how big they are. It depends on how they get their management data and what level of support they need from that. And that is something that your accountant can do. It might be something you need for the bank as well if they have certain covenants you need to adhere to. But it's a question you should ask your accountant.
Okay.
Thank you, David. You talked about how an accountant should help first-time buyers, dentists, and the level of conversations and the questions to ask. And then, of course, principal and dentist. For any one of your clients or looking to sell their practice, how do you advise them and what is the best thing to do? Because obviously the power of information and preparation is key when approaching the market to sell. So how would you advise your clients when it comes to sell their practice?
Both you and I, Max, would say to plan in advance and as far in advance as possible, at least 2 years before. I'd say 2 years because valuations are EBITDA driven and you will need 2 years worth of performance data to justify the exit figure that you're looking to achieve. And yeah, if you are not an associate-led practice, so if you are as the principal doing the majority of the work, the clinical profit is dependent on you and you might not want to stay on. So there might be changes that you need to make in converting it from principal-led to associate-led. That's a big thing to think about. Secondly, making sure that the data is there, that your records are well kept, because once you enter into the due diligence process, there'll be a lot of information requests. And if it's not there, it can slow things down. So I think both of those two things would be key in my mind. The third would be to talk about what your plans will be post-completion. You will have a capital gain when you exit, and in most situations, and you want to make sure that you qualify for entrepreneurs relief, both for yourself and anybody else that might have a stake in the business. So you need to make sure that those qualifying criteria are met for the minimum 2 year period. That's the qualifying time scale for those, as well as discussing, well, what are your options after that? The last thing you want to do when you sell your practice is to sit on a load of cash, because cash isn't very effective from an inheritance tax point of view. It won't qualify for the very generous business property relief that is available to a business or indeed a dental business or any other business. So thinking ahead after that is also important.
Okay, so basically the advice is just make sure that your practice and your business is not reliant on you too much, but perhaps spread income amongst the associates is one of the way to switch the goodwill from personal to commercial, and then it will help the marketability and sellability of the practice.
Yes.
David, it's been a pleasure to have you on the podcast. And again, you've provided us with some great insights into financially planning properly for your practice, and especially before purchasing a practice. I mean, definitely great advice for associates and principals. If any of the listeners would like to get in touch with David, you can contact him on 077 66 137 978, or you can reach out to their website, which is bennettbrooks.co.uk. That's everything for today's show. I hope you've enjoyed it, and stay tuned for next week's show, which is again Wednesday at 8 p.m. And we'll see you soon.
Thank you, Hossein. Thank you, Max.
A word from our sponsors. The Creative Composite, dental marketing which helps you grow. The Pluto Partnership, where professionalism meets confidence.